Hello, and welcome to Navigating Estate Planning with Caress Law. Today, we are going to talk about everyone's favorite subject, taxes. In particular, we are talking about the Oregon estate tax. And I'm also going to shed a little bit of light on some things that you can do to minimize that tax and some planning opportunities that you have during your lifetime to help minimize that tax and pass more of your assets on to your loved ones. I am Tammi Caress. I am founder of Caress Law, and let's get started. And now it's time for the disclaimer. The information contained in this podcast and associated material is intended to furnish listeners and users with general information on matters that they may find to be of interest. The information in this podcast provided by Caress Law and its agents are for general guidance and is not intended to replace or serve as a substitute for any advisory, tax, estate planning, or other professional or legal advice, consultation, or service. Sometimes we may reference third-party materials or websites. Such links or references are only for the convenience of the listener, user, or browser. Caress Law and its agents do not recommend or endorse the content of third-party information or sites. You should consult with appropriate Caress Law professionals or other professional advisors for advice concerning specific tax, estate planning, or other matters before making any decision. In summary, this podcast is not legal advice. If you need legal advice or before acting or making any decision with anything talked about in the podcast, seek the counsel of an attorney. Thanks so much. Okay, the Oregon estate tax. First, what is the estate tax? The estate tax is a tax assessed on the death of an individual. The assessment is based on the gross value of that deceased person's estate. In Oregon, if your gross estate value is over $1 million when you pass away, the Oregon resident is subject to this tax. What is gross estate? Gross estate is all the assets owned by the deceased person. It includes cash in your cash, also cash in your bank accounts. It includes stocks and bonds. It includes real property, so your home, or if you have rental homes or a second home. It includes life insurance, death benefit proceeds. Yes, I know this one, a lot of people can't wrap their head around. But if you have a life insurance policy with a death benefit of, say, $500,000 or $1 million, that value is included in your gross estate for Oregon estate tax purposes. It also includes retirement accounts. The IRA that you have, 401k or similar qualified retirement account is also included in your gross estate. Things like annuities are included in your gross estate. Also cars, your vehicles, tangible personal property. Those are items that are primarily inside your home, family heirlooms, art, jewelry, those sorts of things. Yes, those are required to be reported on the Oregon estate tax return. Now, a lot of people say, wow, are they going to value every single item that I own? No. The rule of thumb is any item that is over, and I'm talking about tangible personal property here, any tangible personal property item that's over $3,000, then that should have its individual appraisal done on that item. So if you have a piece of jewelry that is more than $3,000, it's supposed to be appraised, and we do report that particular item on the Oregon estate tax return. All your other tangible personal property items, we essentially group together, and if there's an estate sale, we'll use what was purchased at that estate sale as the value. Or we'll say, okay, if we were to have an estate sale or even a garage sale, what would we get? And we would estimate it on the estate tax return. So just about anything that you own is what's included. And it's the gross value, meaning we do not deduct, if you will, any mortgage balance off of your gross estate assets. So the threshold for filing this tax return is based on the value of your gross estate. We don't consider your debts in making that determination. Okay, so who is required to file this return? When a deceased person leaves a will or a trust, it will be the person designated under those documents. Under a trust, it would be the trustee. Under a will, it would be a personal representative, also known as an executor in Oregon. We use the term personal representative, but it means the same thing as executor. The person in charge of settling your estate is typically the one who files this return. Now, yes, we have to meet the $1 million threshold if you are an Oregon resident and you have a $1 million in your gross estate, then your fiduciary will file this return at your death. If you are a non-resident, you might also be required to file this estate tax return if you own property located in Oregon. It would be a home, land, condominium. If for some reason you have a car that's registered here, that would be a reason. So if you live outside of Oregon but own property located in Oregon, you might also be subject to this filing. One thing that I think throws people, understandably, is that the threshold is $1 million. For non-residents, it's also $1 million, and it's based on all of your assets. So if you say, let's just say you own vacant land here in Oregon and it's worth $100,000, all your other assets are in Washington State, including your personal residence. Oregon will look at your total value of all your assets. And if it's over $1 million, even though your asset in Oregon is less than $1 million, Oregon requires this estate tax return to be filed. So that's a surprise to many people, but there are planning opportunities that you can do during your lifetime to avoid having that occur if you own real property here in Oregon. So I definitely encourage you to talk to us or an estate planning attorney about that. Because it's a surprise. Now, Oregon will not tax property. This is only for non-residents. So if you're a non-resident and you own real property here in Oregon, Oregon is not going to tax your other assets, but that are not located in Oregon. But if Oregon, it is a formula on the estate tax return to determine what the tax is. And even if your asset in Oregon is under $1 million, it doesn't mean you completely evade the taxes altogether here in Oregon. You still could have an Oregon estate tax return, even though your property in Oregon is under $1 million. So just keep that in mind, some things to be aware of and talk to your estate planning attorney about. Okay. So I talked about the gross estate being valued at over $1 million. To be specific about the valuations, what happens is when you pass away, all your assets need to be valued as of the deceased person's date of death. So someone died on a Monday, it's going to be the value of that asset on a Monday. To get these values, we hire a professional appraiser to appraise real property. So any homes, vacant land, condos, whatever it is, we're going to have a professional appraiser for that. They're going to appraise it as of the date of death. For stocks, we are going to look at the high and low value for that particular stock on the date of death and average it. And that will be used to determine the date of death value for those stocks. Vehicles, same thing. We're going to pull, Kelly's Blue Book or Edmunds.com, or if the vehicle is sold, we're going to use that value to report on the return. Essentially, it is quite a bit of work for your fiduciary. One thing that is super helpful, just to give you a little tip, if you're making a plan for yourself, to make it a little bit easier on your fiduciaries, is to have an asset list with bank account numbers. That way they have a list to go from to get started on the valuation and collecting and gathering those assets. Another helpful tool to leave for your fiduciary is a list of your debts, and also a list of your passwords would be helpful, or at least a place where your password list is located. That's going to make it a little bit easier on your fiduciaries in terms of valuing assets. Next, I'm going to talk about the marital deduction. So deductions in general, but first the marital deduction, because that's a huge one. So there are tax deductions that can be taken on the estate tax return. One big one is called the marital deduction. If the estate, the deceased person's will or trust, gives their property to their spouse, any property going to a spouse is a deduction on the tax return. So if you have an estate where you're giving everything to your spouse, then there'll be a tax return that's required to be filed because your estate is valued over $1 million. However, there will not be a tax assessed. So that's called the marital deduction. You can also leave assets in trust for a spouse, and this marital deduction is applicable if the trust is set up appropriately under your trust document. And of course, you would need an estate planning attorney to help you with that. So that's a big one. So a lot of times when I'm planning for married couples, I'm really looking at the overall plan, not just when the first spouse dies, but when the second spouse dies. And we're trying to minimize that overall tax. Because if you think about it, if a plan is set up to give everything to a surviving spouse now inherits everything. You've just increased the value of the survivor's gross estate, and you've increased the tax because of that. There are things that you can do in your plan to shelter your $1 million exemption. Each person has a $1 million exemption, right? So the first $1 million is not subject to tax. Anything above $1 million is. So if we can at least preserve $1 million and protect that $1 million from being taxed when the surviving spouse passes away, we can save up to $160,000 in taxes. And so marital deduction planning is a big one if you're married. If you are not married, or if you are married, other deductions that are available is the charitable deduction. So assets given to charity at death under your will or your trust is tax deductible. So charitable giving is a big one for those who are so inclined and also want to minimize the overall estate tax burden. Other deductions that can be made that are not standard on any other tax returns are funeral expenses. And also medical expenses. I know there are some deductions for medical if you meet certain thresholds on the income tax return. But here on the estate tax return, there's no threshold. If the deceased person has medical expenses that need to be paid after their death, those are tax deductible expenses. Other administration expenses that are deductible are, hiring the attorney to help you administer or help the fiduciary administer the estate, hiring the CPA to prepare and file any final tax returns, including the estate tax return. Fees often are given to the fiduciary, the person in charge of settling your estate. So those fees are tax deductible. Essentially, the big thing to note for any person who is settling an estate and we have to file this tax return is keep track of all of your expenses, everything from gas mileage to postage, any sort of cost of recording fees associated with the sale of real property. Those kind of expenses can be deducted to try to lower that overall tax burden. What is the estate tax rate? In Oregon, it's between 10 and 16%. And it's a graduated scale. So again, $1 million is the threshold. The first $1 million is not taxed. Anything above $1 million is. The larger your gross estate, the higher the tax. And then finally, there are some tax elections that can be made on a tax return to allow the beneficiaries of the estate or the fiduciary to minimize that tax burden, or at least, essentially minimize the tax burden. Farmland in particular, for example, lots of times we have family that are that own farmland. All the family is involved in the business. And yes, the value of the gross estate is over $1 million, but the value is really in that land. Rather than forcing the sale of that land to pay the tax, the government essentially recognizes this is not the best solution, especially if we want families to continue farming, which we do. So they will allow a certain election and allow payment of that tax over a period of time so that we don't have to liquidate any farmland to pay the tax. There are restrictions associated when we make that specific election for farming land. But, it's good to review those sorts of things with your attorney, even during your lifetime. There's other things that can be done to maybe create some money through life insurance to pay that tax and so forth. So if you really want to minimize the overall tax burden, then it's a good idea to get your plan in place, because there are things you can implement. And there are some things you can do during life to also decrease the value of your gross estate, try to minimize this tax. Okay, so there it is, the Oregon estate tax. I hope this is helpful to you. And again, it's just really important to know about this tax so that you can plan for it when you pass away, because there are some very simple things that can be done to minimize the overall tax burden. The website also has lots of resources. It is www.caresslaw.estate, and that is CARESSLAW.ESTATE. I also have my other podcasts on that website. Look for our next content. And if you have any questions, or if you have any ideas that you want to, or topics that you want to learn more about, please feel free to reach out to us. Thank you, and I hope you have a wonderful day.